Direct indexing is tax efficient.
Yep.
And it's highly customizable. I think that's really underappreciated, the customizable part of it, because no two people in this world are the same. No two people's portfolio should be the same.
Mm-hmm. Yeah.
See, this one I know.
Of course you know this.
Yeah, this one
Everyone
you have
knows
to know.
this, right? Like anybody who turns on terrestrial radio knows this song, right? So
Well, and in the age where aliens are increasingly being talked about more and more by the government and on social media, hey,
Yeah.
terrestrial music,
Right.
not a bad thing.
yeah, exactly. Well, I got some Pink Floyd behind me.
Yeah.
We've used the Pink Floyd album before, and I do love it because it's got that off the wall,
Correct.
that Pink Floyd right.
Crossover.
It's a little bit. It's tangentially related.
Yeah. We can always say they wrote the song for us. You know, they just didn't know it yet.
Exactly right. They were ahead of their time.
Yeah.
So yeah.
Well-
there you go. I mean, and one of my favorite songs. So
Again, not a bad one. I just went with the classic 50s just because bright colors. Let's get some brightness in our day today.
Well, what is a popular song off that album?
See, this is why we have all the albums.
Yeah.
Because oh wow, look at that!
And by the way,
Another Pink
I
Floyd.
think I mentioned this. I think I mentioned this in a previous episode. But like, if anybody listening has records they want to get rid of, let us know. I'll pay the shipping. Like,
Very true. All right, here we go. We have "Johnny Be Good" by Chuck Berry. There you go.
Right.
Simple enough.
okay,
But to keep the space theme going, we have an out of this world topic today because it's one I'm actually really passionate about. So, off the wall today, I think if you're a regular listener, you've heard us talk about. Oh, we're going right into.
just why not? I mean, I think it's the perfect intro music for you, right?
See, I can't hear this song but not think of Michael J. Fox going
That's
Back
right.
to the Future.
Yeah, I know.
Right? A short king, as some people may call him. So, direct indexing. Like I said, a topic I'm super passionate about. I think listeners have heard us talk about what it is before a few times, but we actually got a great follow-up question from someone we were talking to recently about direct indexing that I thought, let's dive into it. This is a podcast episode. I started talking about it with him, and I almost stopped myself and said, you know what? Episode to come.
Yeah, exactly.
And the question really was direct indexing, which we'll talk a little bit about as a quick refresher what it is, but when is it useful? And specifically in different life stages.
Right.
I think a lot of people think direct indexing, when we talk about it, it's a tax efficiency kind of trading strategy.
Mm-hmm.
But really, what are the use cases for it if you're in kind of let's call it the first stage of your life?
Yeah.
If you're working, you're accumulating wealth, you're kind of building towards the future.
Mm-hmm.
And what are the benefits then if you're kind of in the opposite stage? You're starting to draw from your portfolio, you've already accumulated your wealth. How can that really be leveraged for you? So those two stages.
I've got a surprise stage I'm going to throw in there, but I'm going to take you by surprise on it. So
I
you just
love
roll
that.
and I'll just jump in.
Well, then let's start with the quick refresher.
Okay.
For anyone who's unfamiliar, why direct indexing is so powerful is, first off, they can be great investment strategies.
Yep.
Direct indexing is more a trading rebalancing strategy than I would say, an investment selection. You can direct index towards any market index or an investment factor. Say you want to be invested in dividend stocks. You can do direct indexing to dividend stocks or momentum stocks. Maybe you want to do small cap stocks, international, whatever you want to invest in. Direct indexing is kind of the trading and rebalancing that you can overlay on top of it that really provides two benefits. Direct indexing is tax efficient.
Yep.
And it's highly customizable. I think that's really underappreciated, the customizable part of it, because no two people in this world are the same. No two people's portfolio should be the same.
Mm-hmm.
You need to build your portfolio around your life, where you're at, and also, too, your current holdings.
Right.
Direct indexing lets you do all of that. And the main benefit when it comes to just instead building around what you already own is taking advantage of market volatility, market sell-offs to be tax efficient.
Right.
So real quickly, if a individual holding in your direct indexing strategy is trading at a significant loss, you're able to sell that holding, take a tax loss to be used at tax time, but then get immediately reinvested.
Right.
And that's the important thing. You don't want to lose money and stay out of the market or not market time in this strategy. You want to realize that tax loss, but stay invested so when the market does recover, you're riding that wave higher again.
Right. I always use those examples of Lowe's and Home Depot.
It's the simplest one.
Right. Or Coke and Pepsi or anything like that, because you would expect them to act the same given changes in economic situations. So in the example you're talking about, if you've got a loss in Home Depot, it will just shift it out and buy lows,
Mhm.
and then you're fully invested, but you've booked that loss. So instead of waiting for Home Depot to come back, you would assume that Lowe's would come back just like Home Depot would come back when there's a change in circumstances. And so not only do you participate in the recovery of what would have been your Home Depot stock, you booked the loss that you get to write off at tax time. Yeah.
It really is the best of both worlds in some ways.
It's really a great strategy. It works really, really well.
And I think, it sometimes is as simple as that. But sometimes it's really not.
Well, that's a very simple example. It's
Correct.
You and I both know it's way more complicated than that, because really it's not about the names and the sectors lining up. It's about the underlying characteristics of the underlying security. Now I'm going to make up a seriously hypothetical example because I'm talking out of something else when I say this, but the way an oil stock and a car manufacturing company, they may actually have similar underlying characteristics in terms of how it reacts to economic situations. So it's possible that direct indexing can say, we're going to sell Exxon and buy Ford Motor because they act the same. So it's not necessarily lining up apples to apples. It's, are we in the same like fruit basket?
Yeah, it's you don't want to change your allocation.
Yeah,
this doesn't market time or change your allocation. What you're looking for is that my starting, to your point, characteristics around the return profile. So how much return you're kind of expecting, but then also the risks you're taking.
Right.
You don't want to change those. You want to be able to replace that holding, maintain that allocation through it, but again, take that tax loss benefit,
exactly,
which offsets capital gains. And if you don't use it, you can carry forward losses indefinitely under the current tax code.
Right. It's great.
It is. So you're almost building a tax war chest. If you don't need it today, when you have gains later in the future, that's where direct indexing can also be really powerful.
Right. The other thing about direct indexing to keep in mind, as people either embrace it or consider embracing it, is that you really don't understand the alpha or the additional return that you get on top of the strategy until April 15th.
Yeah.
It's the one time a year where you're like, I forgot about that. It's really working because you see that you got the return. You're like, yay, I was up 13% or 15%, just like the index was. That's great. And then you start talking to your accountant about your taxes, and instead of paying capital gains tax on your taxable investment portfolio, you've either got a reduction in your capital gains, if not a complete erasure.
Erasure. I think that's how you said it. Yeah.
Okay, everybody knows what I'm saying, even if the word's wrong. But it could be completely eliminated, and depending on when you embrace the strategy and get invested, it's possible that not only do you eat up all your capital gains, you get to carry some forward into the next year. So it also works well when people are selling businesses and things like that. So it's
correct.
It doesn't eliminate them. It could, but generally it's offsetting at least.
Yeah, and
you have to factor that into return.
Because you're not paying that 20% capital gains tax at the highest bracket or the 15. You're saving 15% on the taxes you would have paid, basically. If you think about it too, I think, again, as we kind of get more into, we have plenty of resources. We talk about this all the time, so I don't want to spend all this episode talking about what direct indexing is. I think when you look at the different life stages, the two that I laid out, so let's start at the first one. You're a working professional, you're building wealth, or a business, let's put it that way too. You're early in your career, you're kind of accumulating your wealth, you're building it. Where is direct indexing most powerful? I think we kind of started to touch on it. I really want to dive in it. It's the tax efficiency of if you don't have capital gains and you start rolling over all these losses. If you have 10 years of your portfolio, and I think it's kind of important to call out, just because you have a tax loss doesn't mean you lost money in your portfolio.
Right.
It is a tax term, but your portfolio over the long term still needs to be performing like the index or the types of stocks you're tracking.
Yeah.
Because if it's not performing, the goal isn't to lose money. The goal is to make money, but be tax efficient.
Right.
So first off, if you're in that accumulation phase, like I said, carrying over those losses to build that tax war chest, because someday when you sell your business, or you have a lot of capital gains because you're starting to maybe look at your portfolio, you have this taxable asset. The tax losses becomes an asset for you to help in the future. But at the end of the day, still, it's got to be a good investment strategy. You need that growth of the market. So direct indexing, while we talk a lot about the trading aspect of it, you still got to be allocated and be invested and stay invested. And like we talked about, there's some direct indexing because a lot of providers, a lot of people do it. Charles Schwab has their own version, JP Morgan. Over the years, everyone has kind of picked up their own direct indexing solution. So you do have to kind of pick which direct indexer you think is doing the best job or offering the most value, because there are costs that come with it. Nothing's free. But they need to be great investment managers. You can't, if some of them are really good at getting you just pure market performance, if you want to start targeting other stocks, that's harder to do. And that's where it comes into picking a direct index provider, someone who can help implement these strategies, more impactful.
Yeah.
So that's really, I think, again, people always like to talk about the tax benefits, but you cannot forget the biggest benefit and the primary benefit is you need someone who's going to get you the performance of these accounts as well.
Right.
Especially early on in your career when you have decades to compound your wealth.
I'll throw in my surprise use case now under this category of, accumulation phase. There are times in an investor's life where they choose to do something different with a portfolio. And a good example of that most people can at least understand if they haven't done it themselves is they move from one advisor to a totally new advisor.
Yeah.
And we see this when clients move into Monument and hire us. There is a high probability that they will be exiting a relationship with a former advisor and coming in here. Now, that means that the investor is going to have portfolios that are constructed, have embedded capital gains, cost basis, things like that. And absent this strategy, in order to align from an old investing strategy to a new investing strategy, there could be, and generally is, asterisk, I'll come back to it, a wholesale revision of the entire portfolio.
Sell all.
Sell everything and reinvest in the portfolios that we manage here, right?
Yep.
That is unpalatable to a lot of people, and understandably so.
Yeah, it could come with a really high tax cost.
It really
some
can.
advisors are just, kind of wiping their hands of it. Or even if you're a DIY investor, same thing. If you've been previously invested but begin to work with someone like Monument, most of the times they're going to say, well, here's going to be your tax cost to join our practice or get our advice.
Or a DIYer could say, like, you know what, I've lost my appetite for picking individual stocks, or I've become too concentrated, or I realized over the past couple of years that being concentrated in the popular stocks, I don't have the time or the tools to do it. So I'm just going to go out and buy a bunch of ETFs. Well, that means you're selling everything. So it could happen to a DIYer also. This can really mitigate that, because you can take an existing portfolio and somebody in accumulation phase that is hiring a new investment advisor or changing strategy or something like that, and import it into this. And then I'm just going to use a very generic example. Let's just say we want the portfolio to track the performance of the Russell 1000 index, right? Big, large cap index.
U.S. stocks,
right? Right. Everybody knows. And if you don't know what the Russell 1000 index is, think S&P 500. Okay. Like just general market exposure, right? So the hamsters that are running on the wheels in the background inside of the computer that are figuring all this thing out are going to look at the portfolio as it exists and say, what changes do I need to make in order for this to look as much like the Russell 1000 or S&P 500 index as I can without selling everything? And it'll say, like, oh, so they own Microsoft, they own Coke, they own IBM, they own all these stocks that are in the index. So here's how we can best fit.
Correct.
And the measurement for a best fit is something that we call tracking error, which is like, hey, how much error can you expect between the reality of the Russell 1000 index and what you have? And there's a measurement for that. It's not important, but like it exists.
Yeah, and it sounds scary because the word error, it's just the difference.
It's just the difference, the delta. Call it the delta, okay?
Yeah.
And over time, the hamsters running on the wheels in the background are going to say, like, okay, Microsoft has just had a 20% decline. So now we can trim some of the Microsoft position out because we can offset it with some other losses and things like that. And it will eventually get the portfolio in line over time without without the same tax consequences if you just wholesale revise the entire portfolio.
Yeah.
So there's a really good use case for it when people are changing strategies. And if there's a listener out there who's hearing this and they're entertaining moving advisors, whether it's us, whatever, it doesn't really matter. If you're moving and your new advisor is saying, hey, I'm sorry, I'm going to have to sell everything, a little alarm bell should be going off in your head and saying like, well, I heard this thing about direct indexing. Do you have that available?
Yeah.
And before you commit to a move, like maybe that's a due diligence question that people should be asking if they're considering an advisor movement.
I think it is, or even so you're kind of touching on how it's highly customizable.
Right.
You can build around your existing strategy. So again, if you have these positions, you don't need to just simply sell them.
Right.
And I think also comes into when you want to reallocate. Let's all of a sudden decide, and you're in your example, Russell 1000 stocks. I now want to be in more dividend paying stocks. There's usually a tax consequence to reallocating like that. For whatever reason, when those transition points come, whether you're, getting into an advisor relationship, changing advisor relationships, or even if you're just reallocating your portfolio,
right,
there's tax consequences. The direct indexing is a great way to mitigate or maybe stretch out that tax impact, and then also identify, well, maybe I don't need to sell all my current holdings. Maybe I only need to sell these ones that don't really fit in my new strategy that I want. Well, okay, then how do we get there? And it can do all that. And this is, again, in addition to every day, some strategies don't do this, but the ones that we really implement here at Monument, look at the accounts every day. And when the losses reach a meaningful point, they're going to automatically sell those losses and keep you invested to whatever your allocation is. And when you need to change, they can give us the full layout and help us figure out, okay, what is the cost of making this change? Is the cost worth the benefits of reallocating?
Right.
So yeah, honestly, it's a great surprise question.
Yeah.
You hit on exactly where we wanted to go.
But that's the accumulation phase. You had another phase.
Yes. Let's flip the script.
Right.
Completely change it, because again, that's a different stage of life that a lot of people eventually reach is, I have all this wealth. I need it to kind of become my income stream. Now, when you're in that stage of life, how does direct indexing, I think, add value to people maybe in that situation?
Right, supporting a lifestyle.
Correct. And again, we talk a lot about using,
Think retirement.
Yeah,
it's really
it's such a dirty word, though.
I know, but just that for the purposes of framing the conversation for listeners, we're talking about like as you move into that stage of your life.
Yes, and the cheesy marketing term that I hate using, but I think is actually really good, is financial freedom. You have accumulated enough wealth. You have enough wealth that you don't need to worry about getting income from a traditional source. Your portfolio can be that. To your point, retirement. That doesn't mean golfing on the golf course or knitting or doing it means doing whatever you want and not worrying about having enough money to live your life.
Right.
So in that stage of life, direct indexing, I guess, where do the benefits come in? I think the biggest one there is, all right, you've had a direct indexing strategy. Performance still matters. Again, I'm going to kind of harp on this again, is your performance, you need your portfolio to continue growing during this retirement phase, this phase where you're drawing down your portfolio. You need the growth to make sure you're not going to run out of money. So still, you have to have a strong investment strategy. But again, now the tax efficiency actually becomes, I think, more important, because here at Monument, we do a lot of total return investing, meaning, yes, our investments generate some level of income, but they also grow in price. So those two components add to your total return, the income you generate and the price appreciation you experience.
Right.
For clients that need money, we rarely satisfy all their cash needs just from the income generated.
It's really hard to.
It is. It's almost impossible.
Unless you've got a massive portfolio and a very small lifestyle.
True.
Right? I mean, which
generally is not the case.
I'm waiting to meet that person.
Yes.
Right? Yeah.
It usually is it's usually you follow the same path on those fields. But when you need to raise money from your portfolio, so what am I saying is, let's say you need $100,000 a year or $200,000. Maybe we can generate about $100,000 of that from the income of the portfolio. Well, now where am I going to get that extra cash that I need? That delta or the difference there of $100,000.
Right. The tracking error.
Yeah. You're going to have to get it from the price growth of your portfolio.
Have to.
So that means you're going to have to sell investments, set that cash aside, just because at Monument here, we value having cash. We say have 12 to 18 months of cash that you can draw on. So in this case, you're going to have to sell from your investments to just replenish your cash bucket from time to time.
Right.
Well, that's going to have capital gains. But here's the thing, the tax efficiency of these direct indexing strategies can be so impactful there. you can maybe raise significant amounts of cash by being tax efficient and realizing less gains than you would have in maybe other traditional investment management strategies. Or you've been using it your whole life and you have this whole, again, war chest of tax losses. So even when you do have gains that you've just been, gains that you realize in 1 year, those losses that you've just been rolling are already there to offset it.
Right.
So I know a specific example is we have a client here who needed to replenish their cash bucket and basically did need about $150,000 to put in. Well, we were able to raise that without significantly changing their tax picture. And that allows for other strategies when it gets into financial planning. Taxes matter for that. So it really helps give you the flexibility to take money out when you need it, and also then set you up to just have a more predictable situation.
Right. And the timing of that decision is worth talking about for a quick second too, because hypothetical situation, somebody in a direct indexing strategy needs $150,000. Okay. It's better to come to that conclusion in January than in December, right? And here's why. Because one, if you have to take those capital gains out of your portfolio to generate the or if you have to take the money out of your portfolio to have the 150 and it generates, the direct indexing strategy has a year to kind of offset those gains. Whereas if you do it in December, you really only have 30 days, let's say, right?
True.
So there's that. And the other thing too is that, and this isn't the biggest planning consideration in the world, but it matters. It's like if you were walking down the sidewalk and you saw $1 on the ground, you'd pick it up, right? Okay.
Yeah.
Or I would.
Maybe not in New York City.
Okay.
I will say that.
Okay,
There's some
fine.
cities I might just walk right by it.
It's got to be a 20 for me to pick it up off the street. Okay.
Fair.
But when you generate, you have 16 months essentially to figure out how you're going to pay those taxes the following April if you do it in January. Versus if you do it on December 31st, you've got 4 months to figure it out.
Yeah.
So there's a little bit more latitude that you get with playing some tax loss harvesting to offset those gains. So it's always better to make those cash replenishment decisions in January than it is in December in a vacuum because of those two things.
Well, and then you get the whole year of market volatility. And we always talk about it. Markets experience declines every year. They're going to experience declines. And this strategy is designed to harvest losses during that decline.
Like now, like the past month or this time last year.
Yeah, exactly. Anytime you go through those big sell-offs, you can realize those tax losses, but then stay invested. Because we also talk about, we have on previous episodes about the market recovery. Market recovering from major volatility events.
And I'll clarify, because somebody may be watching this episode down the road, when I say now, it's April of 2026 as we're recording. And when I say a year ago, I mean the tariff issue from April-ish of 2025. So for anybody who's listening to this in 2032, that's what we're talking about.
Well, and you could go back to 2022.
Sure.
Right?
Well, that's even a better example because you had so much longer to generate those losses.
Correct. And every time the market goes through those events, you might as well be doing something with your money to be efficient.
Yeah.
Because the goal is to ride out the volatility. The goal is not to make drastic changes to your allocation just because of a market event.
Yeah.
But if a market event's happening, man, I'd love to your example, pick up some money on the street and do it on the tax side.
Right.
It's not always going to be necessarily about picking it up maybe, and you won't see it. And I think that's what's tough for people with these kind of strategies.
Yeah.
Is because they're like, oh, so I just paid less taxes, but like I wanted to grow more. And we're like, no, you grew along with the market and you saved money on your taxes. That's the piece that I think a lot of people sometimes can get confused on, or they hear direct indexing, well, they're harvesting losses. I don't want any losses.
Right.
Well, that's also not true.
Right.
It's unrealistic.
And it's also, you have the losses. They're just unrealized. Like the realized ones are more valuable to you.
Correct. As long as, again, you stay invested and stick to the strategy.
Right.
I have seen some people out there who there's, certain tax rules of when you sell a loss, there is a way where if you buy something that is the exact same name, so you sold Coke, you can't buy it for 30 days. But that's why you buy similar names like we were talking about. You don't buy the exact same name back, and you don't want to be out of the market for 30 days and lose lose the gains that you could have had, or buy things too soon. So it just gets really complex. Everything in tax language.
Watch me create this new analogy for you as a wrap up to the whole conversation. Ready? Here it is. Imagine you're on a pogo stick.
Oh, interesting. Okay.
Bouncing up and down.
Yep.
Right? And as you come down, you pick that dirty dollar bill up off the street, and then you spring back up. And each time you go down, you're picking up that dollar. Well, if you're just going up and down and not picking up the dollar, that's the same thing as like buying and holding as the stock keeps going up and down. Wouldn't you rather grab the dollar every time you come down on the pogo stick?
Well, and let's say you have to pogo stick over a set distance too, right? Like your
Or
growth.
set
You,
time.
you still
Right.
get there. It goes up and down, up and
exactly.
down, up and down.
Right.
But on the downs,
On
you
a
made an
city
extra
block.
Yeah, exactly.
Going to Frank's Pizza.
You still got to get to where you need to go. Yeah, I mean, in New York City, you better be getting at least some pizza,
I
is
know,
all I'll
right?
say.
So
And that dollar will help. Maybe it'll pay for the pizza at the end of the
there
day.
you go.
So, well, that's actually a great analogy. I love that now. I haven't pogo sticked in years, and I think it's beyond my
I
time.
hurt myself when I did it, so I've never done it again.
Yeah, that
It's
misses.
very dangerous.
Well, and just to get a little off topic, now I have extreme pogo sticks, which I'm so far out of ones that go like 20 feet in the
Right.
air, whatever. Not for me. So
That and a unicycle, like I just never.
no,
Those things were not attractive to me as recreational activities.
no, we can safely say, hopefully, I'm going to knock on wood, there'll be no broken bones or casts on Off the Wall anytime soon. So, well, I think that's kind of all we got. So
It is.
thank you as
yeah.
always, and thank you to everyone listening.
I'm going to take us out here.
You're going to play us out too? Look at that.
So there you go.
Yeah, right. Johnny be good. Everyone
Right,
be good.
right.
We'll see you next time.
The content presented by Monument Capital Management LLC is intended for general informational and educational purposes only. No portion of this content should be construed as the receipt of or a substitute for personalized investment, financial, legal, or tax advice. Monument is neither a law firm nor an accounting firm, and no content should be interpreted as legal or accounting advice. Any discussions of investment strategies, financial planning concepts, or related topics are general in nature and may not be appropriate for every individual or situation. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment strategy, planning approach, or discussion referenced will be profitable, suitable, or successful for any particular person or circumstance. Past performance is not indicative of future results. From time to time, this content may reference hypothetical situations, illustrative examples, or stories that do not involve actual Monument clients. These scenarios are designed solely to illustrate concepts or demonstrate how Monument might approach similar situations and should not be interpreted as endorsements, testimonials, or guarantees of any particular outcome. No two clients, situations, or experiences are exactly alike, and results will vary. Nothing discussed should be interpreted as a guarantee that any client or prospective client will experience a specific level of results or satisfaction if Monument is engaged or continues to be engaged to provide investment advisory services. Monument's investment advisor registration status or any prior experience should not be construed as an assurance of future performance or success. Copies of Monument's current Form ADV Part 2A, Disclosure Brochure, and Form CRS, which discuss our advisory services and fees, are available upon request or at www.monumentwealthmanagement.com/disclosures.